Let's talk about something that almost nobody talks about honestly. Most financial content is about the gap, the painful, obvious, demoralizing gap between where you are and where you want to be. The retirement account that isn't big enough, the savings rate that isn't high enough, the net worth that isn't growing fast enough, the financial goals that feel perpetually out of reach no matter how many budgeting spreadsheets you create and abandon within 3 weeks. This video is not that video. This video is about the signs, the specific, concrete, behavioral, and financial indicators that you are actually on the right track toward genuine wealth accumulation, even if you don't feel like it, even if your account balance doesn't reflect it yet, and even if the gap between where you are and where you want to be still looks intimidating from the current vantage point. Here's the thing that almost nobody tells you about the process of building wealth. Most of it is invisible. The compound interest that will eventually become the dominant force in your financial life is, in the early years, so small relative to your contributions that it barely registers. The habits that will produce financial independence in 15 years look, from the inside, like ordinary daily decisions that don't feel particularly significant. The identity shift from someone who spends money to someone who builds wealth happens so gradually that you can be well through it without recognizing that it has occurred. The result is a specific and surprisingly common phenomenon. People who are genuinely, meaningfully on the path to financial independence who don't know it, who are experiencing the anxiety of the gap without recognizing the progress that is simultaneously occurring, who are getting richer without realizing it. This video is the recognition that that progress deserves. Not false encouragement, not the kind of content that tells everyone they're doing great, regardless of what they're actually doing, but the specific, honest, behavioral, and financial signs that indicate genuine wealth-building momentum, the things that, when you see them in your own life, are actually worth pausing to acknowledge before returning to the relentless forward push that financial improvement requires. Some of these signs will be obvious once named, some will surprise you. Several will apply to people who have been criticizing their own financial behavior without recognizing that the behavior they've been criticizing is actually evidence of significant progress. Let's go through them. Chapter 1. Your relationship with money has quietly changed, and you've been too busy to notice. Here's the first sign that you're getting rich without realizing it, and it's the most foundational one, the one that underlies most of the other signs on this list, because it operates at the level of psychology rather than at the level of behavior, and psychological change is both harder to achieve and harder to recognize than behavioral change. Your relationship with money has changed. Not dramatically, not in the way that a financial epiphany in a movie changes a character. No single moment of clarity, no dramatic scene where the character tears up their credit card bills and vows to live differently. The change that indicates genuine wealth-building momentum is quieter, slower, and less cinematic than that. It's a gradual shift in how money feels, how financial decisions feel, and what the emotional experience of the financial dimension of life actually is. The anxiety has changed character. Here's the specific psychological shift that most reliably indicates that the relationship with money has fundamentally changed. The anxiety hasn't disappeared. Financial anxiety almost never disappears entirely until the financial goal is fully achieved, but its character has changed. The anxiety of financial precarity is a specific emotional experience. It's the anxiety of not knowing whether the account will have enough at the end of the month, the anxiety of an unexpected expense appearing as a genuine threat to stability rather than an inconvenience, the anxiety of the future that feels genuinely uncertain in the sense of potentially bad rather than uncertain in the sense of potentially extraordinary. This anxiety has a specific texture, it's reactive, it's scarcity-driven, it's about what could go wrong in the near term. The anxiety of wealth building is a different experience. It's the anxiety of impatience, of knowing where you're going and wanting to get there faster. It's the anxiety of opportunity cost, of wondering whether the current allocation is optimal, whether the strategy could be improved, whether there's a decision being made incorrectly that is costing compound growth. This anxiety is forward-oriented and growth-oriented rather than reactive and scarcity-oriented. It feels different in the body. It produces different behaviors, research and optimization rather than worry and avoidance. If your financial anxiety has shifted from, will I have enough this month, to, Am I building fast enough toward my long-term goal? That shift is a sign. Not that the anxiety is gone, but that the thing you're anxious about has changed, which means the underlying financial reality has changed in a direction that matters. Money has become less emotionally charged. Here's the second dimension of the relationship change. Money has become less emotionally charged as a topic and as an experience. For people in financial precarity or in unhealthy relationships with money, financial topics carry enormous emotional weight. Checking the bank balance is an anxiety-inducing event. Conversations about money feel threatening or shameful. Financial planning feels overwhelming because the gap between current reality and the desired state is so large that engaging with it directly is emotionally costly. For people who are building genuine wealth momentum, money has typically become more neutral, not cold or indifferent, but less emotionally loaded. Checking the bank balance is a routine information-gathering activity rather than an anxiety-inducing event. Financial conversations are engaging rather than threatening. Financial planning is interesting because the trajectory is moving in the right direction, and optimizing it is a satisfying intellectual activity rather than a confrontation with inadequacy. The neutralization of money as an emotional topic is a sign because it indicates that the financial situation has stabilized sufficiently that money is no longer a source of threat. And in the absence of threat, the emotional charge dissipates. This doesn't mean the financial work is done. It means the psychological foundation for doing the work consistently over the long term has been established. You think in terms of assets, not just income. Here's the third dimension of the relationship change, and it's the one that most directly correlates with actual wealth accumulation behavior. You've started thinking about your financial situation in terms of assets and net worth, rather than primarily in terms of income and spending. This is the specific psychological shift described in the Psychology of High Earners chapter, the shift from income optimization to wealth optimization. When you naturally ask yourself, what does this do to my asset base, rather than, can I afford this? As the first financial question in a major decision, the optimization target has changed. The financial decisions that follow from that changed question are systematically different in ways that produce different outcomes over time. The specific behavior that most clearly indicates this shift has occurred. You check your net worth regularly, not obsessively, but routinely, and the net worth number carries more psychological significance than the income number. You know your approximate net worth without having to calculate it from scratch. You think about investment returns not just as percentage figures, but as the monthly or annual income those returns represent in dollar terms, because you're modeling what it will feel like when the assets are generating passive income. You have a specific number, a financial independence target, that your decisions are calibrated toward. If this is how you think, you are thinking like someone who is building wealth rather than someone who is managing expenses. That distinction is worth recognizing. Chapter 2. The boring stuff is automated and you've stopped thinking about it. Here's the second sign, and it's the one that will feel least like a sign when you hear it, because the thing that indicates progress is, by definition, something you've stopped thinking about, which means you won't feel it as progress. You'll feel it as nothing, which is, counterintuitively, exactly what it should feel like. Your financial basics are automated and running in the background without requiring your active attention. The automation achievement. Here's why automation is a meaningful sign of wealth-building progress rather than just a convenient feature. Building and maintaining financial automation requires a specific sequence of achievements that most people who haven't started their wealth-building journey haven't completed. To automate meaningful savings, you need to have a positive cash flow, more coming in than going out, that can be directed somewhere before it is spent. You need to have identified the specific accounts and investments the automation should direct money toward. You need to have made the specific decisions about savings rate and investment allocation that give the automation its instructions, and you need to have maintained it long enough that it is a settled feature of the financial infrastructure rather than a recent experiment that is still in the evaluation phase. Each of these requirements represents a level of financial organization and intentionality that a significant portion of the population hasn't achieved. The person whose 401k contribution is automatically deducted at a meaningful percentage of their salary, whose Roth IRA receives an automatic monthly transfer, whose emergency fund is fully funded and sitting in a high-yield account, and whose investment portfolio is being fed by automatic contributions, This person has completed a checklist of financial organization tasks that most people have been meaning to get to for years. The fact that you don't think about it doesn't mean it isn't working. It means it is working exactly as designed. The automation is doing the wealth-building work that the person who hasn't built it is doing manually, with less consistency, less reliability, and significantly more ongoing cognitive effort. The emergency fund that has stopped being interesting. Here's the specific automation achievement that deserves its own acknowledgement, because it represents a genuine transition in financial stability that most financial content describes as a starting point without conveying how significant the achievement actually is. The fully funded emergency fund that you've stopped thinking about. 3 to 6 months of essential expenses sitting in a high-yield savings account, untouched, not being counted as money available for other purposes, generating interest that adds a modest but real contribution to the account balance every month. This is boring. This is not an exciting financial achievement to describe at parties. Nobody is posting about their emergency fund on social media with the caption, "Finally completed this." But the emergency fund that has reached the boring stage, the stage where it is fully funded and sitting quietly in the background without requiring your attention, represents a profound change in financial resilience. It means that the next unexpected expense, the car repair, the medical bill, the appliance failure, the brief income disruption, will be an inconvenience rather than a crisis. The specific anxiety of financial fragility, where any unexpected expense is a potential catastrophe, has been addressed. The foundation has been built. If you have a fully funded emergency fund and you've stopped thinking about it, that's not financial complacency. That's the specific achievement of having built something solid enough that it doesn't require constant attention. Be quietly proud of it before continuing to build. The bills that pay themselves. Here's the third element of the automation sign. Your essential bills are on autopay, and your credit card, if you use one, is paid in full automatically every month. This is so routine that it feels like saying you use a smartphone is a sign of technological sophistication. But the specific combination, bills automated, credit card paid in full, never a late fee, never an interest charge, represents a level of cash flow management and organizational follow-through that a meaningful portion of the population hasn't achieved. The late payment fee industry generates billions of dollars per year from people who have the money to pay their bills on time, but haven't built the systems to ensure it happens reliably. The person who never pays late fees, never pays credit card interest, and never experiences the specific stress of wondering whether a payment went through is operating a significantly more financially efficient life than the person who hasn't built these basic automations. The efficiency difference is real. The average American household that carries a credit card balance pays thousands of dollars per year in interest. The household that pays in full automatically pays zero, and the difference compounds. Chapter 3. You've had the conversation, the one that most people avoid forever. Here's the third sign, and it's the one that has the least to do with numbers, and the most to do with the specific psychological courage that genuine financial progress requires. You have had the conversations about money that most people avoid indefinitely. The conversations, the uncomfortable ones, the ones that require honest assessment of a current situation, honest alignment about a future goal, or honest acknowledgement of a financial behavior that isn't working. The ones that feel awkward to initiate and occasionally produce friction when they happen. The partner conversation. Here's the first and most important financial conversation that most people avoid, and that avoiding it costs them, both financially and relationally, more than they realize. The honest, specific, ongoing conversation with a romantic partner about money. The statistics on financial conflict in relationships are well documented. Money is consistently cited as a leading cause of relationship stress and relationship dissolution. The mechanism is not mysterious. Two people sharing financial resources and financial futures who haven't aligned on the goals, the trade-offs, and the specific behaviors that will determine those futures are carrying a permanent source of unresolved tension that periodically erupts and never fully resolves. The person who has had the full version of the partner money conversation, who knows their partner's specific debts, their partner's specific financial goals, has aligned on a household savings rate and spending framework, has designated accounts and responsibilities, and has a shared understanding of the financial independence target they're working toward, is in a fundamentally different position than the person who has been avoiding the conversation because it's uncomfortable. The full conversation doesn't happen once, it happens in iterations. The first conversation establishing the basic picture, subsequent conversations adjusting the framework as circumstances change, regular review conversations maintaining the alignment over time. The couple that has built this conversation into their regular relationship rhythm is doing something that most couples haven't done, and that the financial outcomes of their partnership will reflect. If you've had the full version of this conversation, not the "we should talk about money sometime" version, but the actual specific numbers and goals version, that is a sign, not a small one. The negotiation conversation. Here's the second conversation that most people avoid, and that avoiding it is financially costly in the most direct and quantifiable way: the negotiation conversation with an employer about compensation. The research on salary negotiation is both clear and consistently ignored. The majority of employees have never negotiated their salary at any point in their career. The majority of employers expect negotiation and have budgeted for it. The expected value of initiating a salary negotiation, accounting for the probability of a successful outcome and the typical magnitude of the increase achieved, is positive for essentially all employees in essentially all contexts. And yet, the conversation feels uncomfortable. It risks rejection. It risks the employer's perception of the employee changing in ways the employee fears. The social discomfort of asking for more than was offered is real enough that most people decline the opportunity repeatedly throughout careers that span decades, leaving hundreds of thousands of dollars in cumulative lifetime earnings on the table in exchange for never having to feel the 30 seconds of awkward silence that follows. I was hoping we could discuss the compensation. The person who has had the negotiation conversation, who has asked for more than was offered, who has made the case for their market value, who has experienced the specific discomfort of the ask and discovered that the world didn't end and the employer didn't rescind the offer, has crossed a specific psychological threshold that compounds financially over an entire career. The first successful negotiation makes the second easier. The habit of negotiating built early produces a career compensation trajectory that the non-negotiator's trajectory doesn't approach. If you've negotiated your salary, even once, even imperfectly, even for a smaller increase than you wanted, that conversation is a sign. The advisor conversation. Here's the third conversation that indicates genuine financial maturity and genuine wealth-building momentum. The conversation with a financial professional, whether a fee-only financial planner, a tax professional, or an investment advisor, that wasn't prompted by a crisis. Most people's first conversation with a financial professional is reactive, triggered by a tax problem, a financial crisis, an estate situation, or the specific moment of panic about retirement that hits in the mid-40s when the timeline suddenly feels real. The proactive version, seeking professional guidance before a problem forces it, as part of the deliberate construction of a financial strategy, is a different and more sophisticated orientation. The person who has proactively sought financial guidance has paid for the professional's expertise rather than hoping for free advice from someone with a product to sell, and has implemented the guidance in a way that has improved the financial strategy. This person has made the specific investment in financial expertise that produces better outcomes than the self-directed approach alone, particularly in the areas of tax optimization, insurance gaps, and investment structure that most people are genuinely not equipped to optimize without professional input. If you've had this conversation proactively, not because a crisis forced it, but because you recognize the value of professional guidance in building your financial strategy, that is a sign of the financial maturity that wealth accumulation requires. The difficult family conversation. Here's the fourth conversation, the one that is simultaneously the most personally challenging and the most consistently avoided, the honest conversation with family members whose financial behavior is affecting your own financial trajectory. The parent who expects financial support that is beyond what you can provide without compromising your own financial goals. The sibling whose financial crises have become a recurring call on your emergency fund. The family expectation of financial generosity that hasn't been calibrated to the reality of your financial situation. These situations are common, and the conversations they require are genuinely difficult. They involve the specific tension between family loyalty and personal financial responsibility that most financial content would prefer to skip. The person who has had the honest version of this conversation, who has been clear about what they can and cannot provide, who has maintained the boundary that protects their financial trajectory without abandoning the family relationship, who has had the awkward conversation rather than silently resenting the obligation or silently depleting their own financial position, has demonstrated a financial self-respect that is genuinely difficult to develop and genuinely necessary for long-term wealth accumulation. Money leaks through family obligation channels that are never addressed, consistently and silently, throughout the wealth-building years of people who haven't had the conversation. The person who has had it has plugged a leak that most people don't acknowledge exists. Chapter 4. Your spending has gotten quieter, and that's louder than you think. Here's the fourth sign, and it's the one that will be most counterintuitive to people who have absorbed the popular narrative, that wealth is visible, that the signs of getting rich are the expensive car, the upgraded wardrobe, the nicer restaurants, the more impressive vacations. The sign this chapter is describing is the opposite of those things. It's the quieting of spending, the specific, deliberate reduction in the noise of consumption that accompanies genuine wealth accumulation, not because wealth builders are joyless ascetics, but because their relationship with spending has matured in ways that reduce the volume of it without reducing the quality of life it produces. The impulse purchase has become rare. Here's the first dimension of the quieter spending sign. The impulse purchase, the unplanned, emotionally driven acquisition of something that wasn't on any list or in any budget, has become genuinely rare rather than a regular feature of your financial life. The impulse purchase is not a moral failure. It is a specific behavioral pattern with a specific psychological driver in the use of consumption as a mood management tool, as a response to boredom, or as a social signal. That is both extremely common and extremely expensive as a long-term financial pattern. The average American makes a significant number of impulse purchases monthly, and the aggregate annual cost of those purchases is, for most households, a meaningful fraction of what could otherwise be directed toward wealth accumulation. The person whose impulse purchases have become rare hasn't necessarily developed superhuman willpower. They've typically developed something more durable, a genuine disinterest in the things that used to trigger impulse purchases, because the psychological drivers have changed. The consumption as mood management pattern diminishes when the emotional relationship with money stabilizes. The social signaling driver diminishes when the peer group comparison that powered it becomes less emotionally relevant. The boredom-driven purchasing diminishes when the attention that was seeking stimulation through consumption finds more satisfying direction elsewhere. If you can walk through a shopping environment, physical or digital, without the specific pull of the impulse purchase that used to characterize those environments for you, that changed response is a sign. The behavioral change is real. The financial consequence of it, sustained over years, is significant. The upgrade cycle has slowed. Here's the second dimension of the quieter spending. The upgrade cycle, the regular replacement of functional items with newer, more expensive versions, primarily because the newer version exists rather than because the current version has stopped working, has slowed or stopped. The upgrade cycle is one of the most effectively marketed consumption patterns in the modern economy. The smartphone that is functionally excellent but is now 2 model years old. The car that runs perfectly but is 4 years old in a social environment where 3-year replacement is normalized. The kitchen that is fully functional but features finishes that were fashionable 6 years ago. The wardrobe that covers the body entirely adequately but doesn't reflect the current season's offerings. Each individual upgrade is justifiable on its own terms. The aggregate annual cost of maintaining the upgrade cycle across all the categories it applies to is substantial, often $10,000 to $30,000 per year for households in the middle and upper middle income range, and the wealth accumulation foregone by this spending is enormous over decades. The person who has genuinely slowed the upgrade cycle, who drives the paid-off car until it actually needs replacement, who uses the functional phone until it genuinely stops serving its purpose, who furnish the home with things that will be kept, rather than things that will be replaced when trends change, is capturing a significant share of their income for wealth accumulation that the upgrade cycle participant is redirecting to consumption. The specific psychological shift that enables the upgrade cycle to slow, the status and satisfaction that the upgrade previously provided, has been partially replaced by the satisfaction of the growing investment account, the increasing net worth, the progress toward financial independence. The new phone doesn't feel as rewarding when the alternative use of the money feels more rewarding. This shift in the source of satisfaction is a sign that the wealth-building psychology has genuinely taken root. The quality over quantity shift. Here's the third dimension of the quieter spending sign that is most frequently misunderstood. The wealth-building spending pattern is not primarily about spending less on everything. It is about spending more intentionally, which often means spending more on specific things while spending dramatically less on others. The person who has genuinely developed the wealth-building spending orientation often spends more per item on the things they buy, because they buy fewer things and they buy things that last, while their total spending is lower than it was when they were buying more things more frequently. The expensive, well-made piece of clothing that is worn for 10 years is a better financial decision than the cheap, fashionable piece that is worn for one season and discarded. The high-quality appliance that runs for 15 years is a better financial decision than the budget appliance that requires replacement every 5. This quality over quantity shift is a sign because it indicates a temporal reorientation, thinking about the total cost of ownership over time rather than just the upfront price. That is one of the foundational cognitive practices of the wealth-building psychology. The person who naturally thinks about how long they'll own something and what the cost per year of ownership is, rather than just what the price tag says, is thinking about money in the way that wealth accumulation requires. The contentment that doesn't require spending. Here's the most significant and most difficult to develop dimension of the quieter spending sign: the emergence of genuine contentment that doesn't depend on spending as its primary expression or source. The specific cultural pressure of the modern consumer economy is the equation of happiness with consumption, the systematic, relentless marketing message that feeling good requires buying something. This message is so pervasive and so consistently reinforced by the social environments of most people's lives that disentangling it from genuine preferences is genuinely difficult. The person who has done this disentangling, who has discovered that their genuine sources of satisfaction are not primarily consumptive, has achieved a specific form of financial freedom that precedes financial independence and makes financial independence more achievable. The non-consumptive sources of satisfaction that wealth builders consistently describe as genuine replacements for spending-driven contentment include the quality of their most important relationships, the engagement with meaningful work or creative activity, the physical well-being that exercise and health investment produces, the intellectual engagement of learning, and the specific satisfaction of watching the financial trajectory move in the right direction. None of these things are free in the absolute sense. Relationships require time. Meaningful work may require investment in skill development. Health requires some financial investment. But their cost is far lower per unit of genuine satisfaction than the consumption-driven alternatives, and their compound return, in life quality, in health, in the richness of relationships, exceeds what the same investment in consumption would produce. If you've genuinely found this, if your contentment is less dependent on spending than it used to be, that shift is a sign that the wealth-building psychology has developed to a level that the external financial results will eventually reflect. Chapter 5. Your financial knowledge has crossed a specific threshold. Here's the fifth sign, and it's the one that will feel most like a participation trophy to people who prefer hard metrics over psychological indicators, which is why this chapter is going to be specific about what the knowledge threshold actually is, why crossing it matters, and what the behavioral evidence of having crossed it looks like in practice. Your financial knowledge has crossed the threshold from theoretical to operational, from knowing that certain financial practices are important to actually understanding them well enough to implement and maintain them correctly without constant external guidance. You know what you own and why. Here's the first and most basic dimension of the operational knowledge threshold. You know what is in your investment, accounts, why it is there, and approximately what it should cost to hold it. This sounds absurdly basic. It is not. A significant proportion of people with investment accounts, including people who have been investing for years, cannot accurately describe the holdings in their portfolio, cannot explain the investment thesis for those holdings, and are genuinely uncertain what expense ratios they are paying. They have money in accounts. The accounts are doing something. The annual statement arrives and is filed without being read carefully. The person who knows what they own, why they own it, and what it costs to own it has crossed the first threshold of operational investment knowledge. They can explain their portfolio to someone else in plain language, not in financial jargon, but in the actual underlying logic. They know whether they are holding a total market index fund or an actively managed fund, and they know the difference and why it matters. They know their expense ratios, and they know whether those ratios are competitive with alternatives. They know their asset allocation, and they know why it is appropriate for their time horizon and risk tolerance. This knowledge is not sophisticated. It does not require a financial background. But it is specifically the knowledge that enables the investor to maintain their strategy through market volatility, because you are much more capable of staying invested through a 30% market decline when you understand why you own what you own than when you're holding things whose logic you never fully grasped. You understand the tax structure of your wealth building. Here's the second dimension of the operational knowledge threshold. You understand, at a practical level, the tax implications of the accounts you're using and the investment decisions you're making, specifically enough to make decisions that reduce the tax cost of wealth accumulation. The specific knowledge this refers to, understanding the difference between pre-tax and post-tax retirement accounts and when each is advantageous, understanding how capital gains taxes work and why holding investments for more than a year matters, understanding what tax loss harvesting is and whether it is relevant to your situation, understanding why the order in which you fill different account types, 401k to match, then Roth IRA, then HSA, then back to 401k, then taxable, matters for after-tax wealth accumulation. Understanding whether your income level makes a Roth or traditional IRA more advantageous and why the answer might change over time. None of this knowledge is exotic. All of it is practically important. And the person who has developed it, who has done enough reading, enough planning, enough engagement with their own financial situation, is making systematically better decisions about how to structure wealth accumulation than the person who has money in accounts but doesn't understand the tax architecture they're operating within. The tax drag on wealth accumulation for people who don't optimize the structure is real and compounding. The person in the 24% marginal tax bracket who is putting money in a taxable account when they have unused Roth IRA capacity is paying 24 cents on every dollar of growth in unnecessary taxes. Over decades of compounding, this is a significant wealth reduction. The person who knows better does better, specifically because the knowledge translated into a different structural decision. You can explain compound interest to someone else. Here's the third dimension of the operational knowledge threshold that is deceptively simple and genuinely important. You can explain compound interest, specifically the actual mathematical mechanism by which it works and why it is more powerful over longer time horizons, in plain language to someone who has never encountered the concept. The reason this specific capability is a sign is not because the explanation is difficult, but because being able to explain something to someone else is a reliable test of whether you actually understand it, rather than having a vague familiarity with the concept. The person who can give the actual compound interest example, here's $10,000 at 7% annual return, here's what it is worth in 10 years, in 20 years, in 30 years, and here is why the 30-year number is so much larger than 3 times the 10-year number, has internalized the concept in a way that changes their behavior. The behavioral change that genuine understanding of compound interest produces is the specific urgency about starting and maintaining investment contributions that the person who understands it intellectually but hasn't internalized it doesn't feel. When you genuinely feel the difference between starting at 25 and starting at 35, not just know it abstractly, but feel the specific financial consequence in a way that is emotionally real, you make different decisions. About the timing of investment, you don't wait for conditions to be perfect. You don't defer the Roth IRA contribution to next year when things settle down. You start now, even imperfectly, because the cost of delay is viscerally understood. You've stopped seeking financial validation from non-experts. Here's the fourth dimension of the knowledge threshold that is most clearly behavioral. You've stopped seeking validation for your financial decisions from people who are not in a position to evaluate them, and you've started evaluating your own decisions against the logic that underlies them, rather than against the opinions of people around you. The person who is still in the pre-threshold knowledge state asks their friends, their family, their social media following whether their financial decisions are good ones, not because those people have relevant expertise, but because the anxiety of uncertainty drives a search for reassurance from whatever source is available. The problem with this pattern is that the reassurance provided by non-experts is calibrated to what sounds right to people without the relevant knowledge, which is frequently wrong in ways that are not visible to either party. The person who has crossed the knowledge threshold asks different questions to different sources. They validate the logic of their decisions against the underlying financial principles rather than against social consensus. They seek expert input on specific technical questions, tax optimization, insurance structure, estate planning, rather than general reassurance. They distinguish between the uncertainty that requires more information and the uncertainty that simply requires tolerating ambiguity until more data is available. This shift from social validation to principled self-assessment is a sign of genuine financial knowledge development, and it produces better decisions specifically because the feedback loop is better calibrated. Chapter 6. Your income has more than one source. Even if the second source feels tiny. Here's the sixth sign, and it's the one that will immediately trigger an objection from people whose second income source is so small that it feels more like a rounding error than a financial achievement. You have more than one source of income, and the specific significance of this is not in the current dollar amount of the second source, but in what having it at all represents and where it is going. The single income vulnerability. Here's the context that makes the second income source sign meaningful. The single income household, whether that single income comes from one job, one business, or one income-producing asset, is fundamentally more financially fragile than the multiple income household, regardless of how large the single income is. The vulnerability is simple and specific. A single income source can be disrupted by a single event, a layoff, a health issue, a business contraction, an industry disruption, a relationship change, in a way that eliminates 100% of income simultaneously. The multiple income household, even if the second income is small, cannot experience the same total income disruption from a single event. The second income source, whatever its current size, is a diversification of financial risk that has genuine value independent of its current dollar contribution. This is not merely theoretical resilience. The COVID pandemic provided a specific, large-scale natural experiment in income source vulnerability. Households with multiple income sources were dramatically more financially resilient than single-source households when one income was disrupted because the disruption was partial rather than total. The gig income, the freelance income, the small rental income, the modest investment income, all of these provided partial buffers that kept some households from financial crisis, while single-source households of similar total income experienced complete disruption. The side income that feels irrelevant. Here's the specific version of the second income sign that most people dismiss as too small to count. The side income, the freelance project, the occasional consulting work, the Etsy shop generating $200 per month, the content platform with modest monetization, the occasional service work, that feels negligible relative to the primary income. The reason this small second income is a genuine sign of wealth building progress is threefold. First, it represents the activation of an income-generating capability outside the primary employment relationship, a capability that can be scaled. The Etsy shop generating $200 per month is not a $2,400 per year asset. It is a proof of concept, evidence that the model works, that the demand exists, that the capability has been demonstrated, whose scale is limited primarily by the investment of time and resources directed toward it. The person who has built $200 per month from a side income has crossed a specific capability threshold that the person who hasn't tried has not. Second, it represents a specific mindset about income generation that is fundamentally different from the employee mindset that most people operate within. The employee mindset models income as something that is received in exchange for time and labor provided to an employer. The side income operator has demonstrated, in practice, the alternative model. Income can be generated by creating value in the market directly without the intermediary of an employer, and the ceiling on that income is the ceiling of the value being created rather than the ceiling of what an employer is willing to pay. Third, the small side income is almost always a learning investment as much as an income investment. The skills developed in building and running even a small income-generating activity, marketing, customer service, product development, pricing, financial management at a small scale, are directly transferable to larger income-generating activities and have a practical educational value that no classroom program provides with equivalent efficiency. The investment income, that's still rounding error territory. Here's the second version of the multiple income source sign, the investment income, the dividends, the interest, the rental income, that is currently so small relative to earned income that it barely registers as a financial factor, but that represents the embryonic form of the passive income that financial independence is built on. The investment portfolio generating $50 per month in dividends and interest is not a meaningful income source today. It is evidence of a portfolio that is building toward becoming one. The $50 per month at current portfolio size is the same mechanism, dividends, interest, returns, that will generate $3,000 per month from a larger portfolio, $6,000 per month from a larger one still, and eventually the full living expenses of financial independence from the portfolio that results from decades of consistent contribution. The person who has started tracking their investment income separately, who knows that their portfolio generated $600 last year in dividends and interest, and who is watching that number grow year over year as the portfolio grows, has made a specific cognitive move toward the wealth-building psychology. They have identified the passive income trajectory as a meaningful metric, which means they are optimizing for it in ways that produce different investment decisions than the person who thinks only in terms of total portfolio value. The geographic income diversity. Here's the third version of the multiple income source sign that most people don't think of as a separate income source. Income that is not geographically dependent on your current location. The person whose entire income requires their physical presence in a specific location, the job that requires showing up, the clients that require local service, is more geographically constrained than the person who has developed any income source that functions regardless of location. The freelance income, the digital product sales, the investment income, the remote consulting, each of these represents a partial decoupling of income from geographic location that has genuine financial value. The value is not primarily in the ability to work from anywhere, though that is a real benefit. It is in the specific resilience to local economic disruption, the regional recession, the industry contraction in a specific market, the personal circumstance that requires relocation, that geographically independent income provides. The person with any meaningful geographic income diversity is less vulnerable to the specific category of local economic disruption that affects geographically concentrated income sources. The royalty and recurring revenue model. Here's the most advanced version of the multiple income source sign, the one that represents the clearest evidence of wealth-building thinking about income, the development of any income that recurs without requiring proportional ongoing effort. Royalties from creative work, subscription revenue from a digital product, recurring maintenance contracts from a service business, licensing income from intellectual property, commission overrides from a sales organization. These are all forms of income that were created through a one-time or concentrated investment of effort, and that continue generating revenue without requiring the same effort to be repeated for each dollar received. The person who has built even a small recurring revenue stream, the $30 per month from a digital product, the $50 per month from a content platform, the modest ongoing income from a created asset, has developed the specific understanding that income and effort are not required to be proportional that distinguishes the wealth-building income architecture from the time-for-money model that most people operate within entirely. This understanding, once developed through actual practice, changes how future income opportunities are evaluated. The recurring revenue model becomes the preferred model, not because the upfront investment is lower, but because the ongoing return per unit of effort is higher, and the asset created has value that can be sold independently of the ongoing income it generates. Chapter 7. Your relationship with time has fundamentally shifted. Here's the seventh sign, and it's the one that sounds most like a philosophical observation, until you understand the specific financial consequences it produces. Consequences that are as real and as measurable as any balance sheet figure, even though they show up in the decisions made rather than in the accounts held. Your relationship with time has changed. Specifically, the way you experience, value, and allocate your time has shifted in ways that are directly connected to the wealth-building trajectory you're on. And the shift itself is both a sign of the progress made and a driver of the progress still to come. Time has become the scarcer resource. Here's the specific shift in the time-money relationship that occurs as wealth accumulation progresses. Time gradually replaces money as the resource that feels most constrained. For most people in the early stages of their financial lives, money is the binding constraint. The experience of financial limitation is primarily the experience of not having enough money to do or have the things that would improve quality of life. Time is, if not unlimited, at least not the primary source of frustration. There are evenings, weekends, vacation days, and the ambient sense that time is broadly available, even if some of it is committed. As wealth accumulation progresses, as the financial situation stabilizes, as the income grows, as the investments compound toward the point where they represent meaningful resources, a specific inversion begins to occur. Money becomes progressively less constraining as the resource base grows. Time becomes progressively more constraining as the opportunities, obligations, and activities that are worth doing exceed the available hours to do them. This inversion is a sign because it indicates that financial progress has reached the level where money is no longer the primary limiting factor, which is a meaningfully different financial position from the one where it is. The person who feels more constrained by time than by money has crossed a specific threshold in the financial trajectory that most people are still working toward. The hourly rate calculation has become automatic. Here's the behavioral manifestation of the change-time relationship: the automatic calculation of effective hourly rate for the activities that consume time, and the use of that calculation to make outsourcing and delegation decisions. The person who has developed a genuine sense of what their time is worth, based on their actual hourly earnings from employment or business, their marginal ability to generate additional income from additional time, or their sense of what an hour of their time produces in financial or personal value, makes systematically different decisions about what to do themselves and what to pay others to do. The 2-hour task that would cost $40 to outsource, performed by someone earning $80 per hour from their primary work, is a rational outsourcing decision. The 2 hours released is worth more in alternative use than the $40 costs. The same calculation applied across the full range of household tasks: cleaning, lawn maintenance, certain home repairs, administrative work, gradually shifts the allocation of personal time toward the higher value activities that justify the cost of the outsourced lower value ones. This is not about being too good for certain tasks. It is about the specific resource allocation logic that becomes increasingly relevant as income and time scarcity both increase. The wealthy person who outsources the lawn mowing is not being lazy. They are allocating the hour freed to an activity, whether that activity is income generating, relationship investing, or genuinely restorative, that produces more value than the $50 the lawn service costs. If you have started making these calculations naturally, if the cost of outsourcing something is automatically compared to the value of the time it would free rather than simply evaluated as an expense, that automatic calculation is a sign of the time value orientation that wealth accumulation eventually produces. The calendar reflects priorities rather than requests. Here's the third dimension of the change-time relationship. The calendar has become primarily a reflection of your own priorities rather than primarily a collection of other people's requests for your time. Most people's calendars are primarily reactive. They fill with whatever meetings, obligations, and requests arrive in roughly the order they arrive, subject to the physical constraints of the calendar. The result is a schedule that reflects the priorities of whoever made requests rather than the priorities of the person whose time is being allocated. The person who has developed the time as the scarcer resource orientation has, to a greater or lesser degree, reclaimed the calendar, has built in protected time for the highest leverage activities before other requests can fill it, has developed the practice of evaluating meeting requests against the value they produce rather than accepting them by default, and has built enough deliberate structure into the week that the most important work happens before the most urgent requests can prevent it. This calendar reclamation is a sign because it requires the specific combination of clarity about what matters most, confidence to protect time for it against social pressure, and sufficient financial stability that the political cost of occasionally declining requests is not catastrophic. All three of these conditions are more available to the person who is genuinely building wealth than to the person in financial precarity who cannot afford the political cost of protecting their time. The leisure quality has improved, while leisure quantity may have decreased. Here's the counterintuitive time relationship sign that confuses people when they first encounter it. Many people who are genuinely building wealth find that their leisure time has become higher quality and more intentional, even as, sometimes especially as, the quantity of it has temporarily decreased during high growth periods. The leisure of financial anxiety is not genuinely restful. The person who has evenings free but is spending them in low-grade worry about financial situations has the quantity of leisure. Without the quality, the person who has fewer evenings free but spends them in genuine presence, with relationships that matter, in activities that genuinely restore, without the background hum of financial anxiety, has less leisure quantity and more leisure quality. The specific improvement in leisure quality that accompanies genuine financial progress is the reduction of the background financial anxiety that previously prevented full presence in non-work time. The dinner that is genuinely enjoyed because the bill is not a source of stress. The vacation that is genuinely restorative because it is not being partially funded by debt that will outlast the memories. The weekend that is genuinely free because the week's financial obligations have been met without drama. If your leisure has become more genuinely restful, if the background financial anxiety that used to accompany ostensibly free time has diminished, that quality improvement is a sign of the financial progress that produced it. Chapter 8. You've experienced your first real financial setback and survived it. Here's the 8th sign, and it is the one that will be least expected on a list of signs that you're getting rich, because the sign is not an achievement or a positive milestone, but a negative event. You have experienced a significant financial setback, and you are still here, still building, still on the trajectory. The financial setback and the survival of it is a sign of wealth-building resilience that the person who hasn't been tested doesn't yet know they have. The setback that didn't break the trajectory. Here's the specific financial event that qualifies as the setback this chapter is describing. Not a minor inconvenience. Not a month where the budget was tight, but a genuine financial shock. A job loss, a medical expense that exceeded the emergency fund, an investment that lost significant value, a business that failed, a divorce, a major unexpected expense that required real adaptation and produced real financial pain. The person who has experienced this event and whose financial trajectory has recovered, who is back on track, who has rebuilt the depleted emergency fund, who is contributing to investments again, who has not abandoned the financial strategy in response to the setback, has demonstrated a resilience that no amount of planning can guarantee in advance. They know from direct experience that they can absorb a significant financial blow and recover from it. This knowledge changes the psychological relationship with financial risk in ways that are genuinely valuable. The specific psychological value of having survived a financial setback. It reduces the catastrophizing that financial anxiety produces about future risks. The person who has never experienced a major financial setback imagines the consequences of one in the worst-case terms: complete financial ruin, permanent derailment, catastrophic consequences. The person who has experienced one and recovered knows something more accurate. The setback was genuinely difficult, the recovery was genuinely effortful, and the financial position after recovery is not permanently damaged. The worst case, experienced, was survivable. This knowledge, experiential rather than theoretical, changes the risk tolerance in financially productive ways. The investment that seemed too risky because the potential loss felt catastrophic feels different when the investor knows from direct experience that significant losses are survivable and recoverable. The business risk that seemed unacceptable feels different when the entrepreneur knows they have recovered from a previous business failure without permanent financial consequence. The emergency fund that actually got used. Here's the specific version of the setback survival sign that is most directly financial. The emergency fund that was actually deployed for an emergency and subsequently rebuilt. The emergency fund that was never used exists in a theoretical relationship with the person who built it. They know it is there, they are glad it is there, but they have never experienced the specific relief of having it available when it was genuinely needed. The emergency fund that was used and rebuilt has a different relationship. The person knows with absolute experiential certainty what it is for and why it matters, because they have been the person who needed it and had it rather than the person who needed it and didn't. The rebuilt emergency fund, the one that was depleted by an actual emergency and restored through deliberate saving, represents the financial resilience cycle completed. The system was tested, the system worked, the system was restored. This is not a failure. It is the emergency fund performing exactly its designed function, followed by the financial discipline of rebuilding it, which demonstrates that the system is maintained rather than merely built once. The investment that lost value and was held through the loss. Here's the second specific version of the setback survival sign. The investment that declined significantly in value and was held through the decline rather than sold at the loss. This experience, holding an investment through a significant drawdown, watching the account value decline by 20%, 30%, 40% without selling, is one of the most psychologically demanding experiences that long-term investing requires, and one that a significant number of investors fail at the first time they face it. The combination of seeing large nominal losses on a screen and the relentless media narrative about why the decline might continue produces a selling pressure that only genuine understanding of the investment thesis and genuine long-term orientation can resist. The investor who held through a significant drawdown and subsequently watched the investment recover, and who has the specific experiential knowledge that the paper loss that looked permanent eventually resolved, has developed an investment psychology that the investor who has only experienced rising markets hasn't developed. They know, not theoretically, but experientially, that market declines are temporary and that the permanent loss occurs primarily through selling at the low rather than through the decline itself. This experiential knowledge is worth more than an equivalent amount of financial education content because it has been integrated at the emotional level where investment decisions are actually made, rather than remaining at the intellectual level where investment decisions are rationalized. The income disruption that was absorbed. Here's the third version of the setback survival sign. The income disruption, the job loss, the period of reduced hours, the business downturn that was absorbed by the financial infrastructure you had built without catastrophic consequence. The person who lost a job and discovered that their emergency fund covered 3 months of expenses while they found the next position, who experienced the job loss as stressful but not financially catastrophic, has confirmed the value of the financial infrastructure they built. The abstract knowledge that an emergency fund is important has been converted into experiential confirmation that it worked when needed. This experiential confirmation has a specific motivational consequence. The person who has experienced their financial infrastructure performing its protective function is a more committed builder of that infrastructure than the person who has only been told about its importance. The abstract case for financial resilience became concrete when the resilience was tested and held. If you have experienced a significant financial setback and your trajectory has recovered, that recovery is a sign, not just of your financial infrastructure, but of your financial character. The two things that financial character consists of are the discipline to build during good times and the resilience to rebuild after bad ones. Having demonstrated both, you have demonstrated something that no account balance can convey. Chapter 9. The specific behavioral signs that are easy to miss. Here's the chapter that collects the behavioral signs, the specific things you do and don't do in daily life, that are individually subtle but collectively constitute a clear picture of someone who is genuinely on the wealth-building path. These are the signs you might read and think, that's just normal behavior, which is precisely the point. These behaviors have become your normal. That normalization is the sign. You read the fine print. Here's the behavioral sign that is so mundane it almost didn't make the list, and that is so financially significant it absolutely had to. You read the fine print. Specifically, you read the terms of financial agreements. Before signing them, the credit card terms, the loan documents, the insurance policy details, the investment account fee schedule, and you understand what you're agreeing to before you agree to it. The financial industry is specifically structured around the assumption that most people don't read the fine print, and the products that are most profitable for the industry are the ones whose true cost is most effectively obscured in the fine print that most customers ignore. The credit card with the generous rewards program and the 29% penalty APR, the investment account with the low headline fee and the significant administrative charges buried in the fee schedule, the insurance policy with the coverage that sounds comprehensive until the claim reveals the exclusions. The person who reads the fine print, who understands what they're agreeing to, and who selects financial products based on the full picture, rather than the headline features, is systematically avoiding the specific financial products that transfer wealth from customers to financial institutions most efficiently. Over a financial lifetime, the aggregate cost of the fine print traps that are avoided is genuinely significant. Not through any single dramatic decision, but through the accumulated avoidance of the small, persistent fees, penalties, and unfavorable terms that compound against the person who doesn't read carefully. You have a will and basic estate documents. Here's the behavioral sign that most young wealth builders have been meaning to get to and haven't. You have a will, a healthcare directive, and beneficiary designations that are current on all relevant accounts. The percentage of Americans without a will is consistently above 50% and approaches 70% in younger age groups, which means that the majority of people who die without one leave their families to navigate the specific legal and financial complexity of intestate succession at the moment when that complexity is most costly to navigate. The will is not a complex document for most people. It is a specific, deliberately expressed statement of how assets should be distributed and for parents who should care for minor children. Failing to create it is not a minor oversight. It is a specific, consequential decision to leave those questions unresolved. The person who has created basic estate documents, however simple, has demonstrated the specific financial maturity of thinking about their financial situation in a time horizon that extends beyond the immediate and includes the possibility of their own death or incapacity. This temporal extension of financial thinking is the same cognitive orientation that makes long-term investing, delayed gratification, and compound interest intuitive rather than abstract. The beneficiary designation point deserves specific emphasis. The beneficiary designations on retirement accounts and life insurance policies override the will entirely. The person who has a carefully crafted will but whose retirement account still lists an ex-spouse as beneficiary because the form was never updated has a specific and potentially devastating estate planning gap. The person who has reviewed and updated all beneficiary designations has addressed this specific gap. That review is a behavioral sign of the financial thoroughness that wealth accumulation requires. You've increased your insurance coverage as your assets have grown. Here's the behavioral sign that is most directly evidence of the asset building progress this video is about. You have reviewed and increased your insurance coverage as your financial position has grown. The specific insurance gaps that indicate wealth building progress when they're addressed. The life insurance coverage that has been increased from the default employer provided amount to the amount that would actually replace your income and maintain your family's financial position for a meaningful period. The disability insurance that has been reviewed and confirmed to cover your actual income rather than a default percentage of an outdated salary. The umbrella liability policy that has been added to protect the asset base that has grown to the level where a lawsuit without adequate coverage could genuinely damage the financial position. The person who has umbrella liability coverage is specifically a person who has assets worth protecting, because the umbrella policy is only relevant when there are assets for a plaintiff to reach. The decision to purchase it is therefore both a sign that assets have grown to the level where protection is warranted and evidence of the financial maturity to recognize and address the exposure. You've stopped paying for things you don't use. Here's the behavioral sign that sounds trivially obvious and that a remarkable number of people don't follow through on. You have audited your recurring expenses and canceled the subscriptions, memberships, and services that you are paying for without using. The average household has more active subscriptions than it can accurately enumerate from memory. The streaming services that were added during specific periods and never canceled when the period ended. The gym membership that is paid monthly without a visit. The software subscription that was needed for one project and continues charging. The subscription box that seemed appealing and became an obligation. The magazine subscription that is read by no one. The app subscription that was on a free trial and converted to paid without notification. The aggregate monthly cost of unused subscriptions in the average household is typically $50 to $200 per month, $600 to $2,400 per year for things that are producing zero value. The person who has done the audit, identified the unused subscriptions, and canceled them has recaptured this money for wealth accumulation without any reduction in actual quality of life because the canceled subscriptions were already providing no value. The behavioral significance of the audit is not primarily the money recovered, though that is real and meaningful. It is the evidence that the person is managing their financial life actively rather than passively, that they are paying attention to where money is going and making deliberate decisions about what it should fund. Active financial management is the behavioral foundation that all the other wealth-building behaviors rest on. You think about the financial implications before committing. Here's the final behavioral sign in this chapter, the one that is most broadly applicable and most consistently present in the behavior of people who are building wealth. You think about the financial implications of significant decisions before committing to them rather than after, not obsessively, not to the point of paralysis, not with the anxiety of someone who views every decision through a purely financial lens, but genuinely as a natural part of the decision process rather than an afterthought. The job offer is evaluated in terms of total compensation, benefits, retirement match, and career trajectory, not just the salary number. The housing decision includes a realistic assessment of total ownership costs, mortgage, taxes, insurance, maintenance, opportunity cost of equity, not just the mortgage payment. The car decision includes the total cost of ownership over the intended ownership period, purchase price, insurance, fuel, maintenance, depreciation, not just the monthly payment. The before versus after distinction matters specifically because the decision that has been financially evaluated before commitment can be structured, negotiated, or declined based on that evaluation. The decision that is financially evaluated after commitment is evaluated too late. The information produces regret or adjustment planning rather than better decision-making. Chapter 10. The net worth trajectory sign. When the numbers tell the story. Your feelings don't. Here's the 10th sign, and it's the one that brings the abstract psychological and behavioral indicators of the previous chapters into contact with the specific, measurable financial reality that ultimately defines wealth accumulation, the net worth trajectory, not the absolute net worth number, which tells you where you are but doesn't tell you whether you're moving in the right direction at the right speed. The trajectory, the direction and rate of change in net worth over time, which is the actual evidence of wealth-building momentum that feelings and behaviors can indicate, but only numbers can confirm. The net worth is growing faster than you're contributing. Here's the specific mathematical milestone that indicates genuine wealth-building momentum has been achieved. The point at which your net worth is growing at a rate that exceeds your annual contribution to it, the point where the investment returns on your existing asset base are contributing more to net worth growth than your new savings contributions. For most people in the early stages of wealth accumulation, the primary driver of net worth growth is contributions, new money going into accounts each month. The investment returns exist but are small relative to the contributions because the asset base is small. A 7% return on $10,000 is $700 per year. Significant as a percentage but small in absolute terms relative to a meaningful annual savings contribution. As the asset base grows, the relationship gradually inverts. A 7% return on $200,000 is $14,000 per year. On $500,000, it is $35,000. On $1 million, it is $70,000. At some point, And the specific point depends on the size of the contributions and the size of the asset base. The return on existing assets exceeds the new contribution, and net worth growth is driven more by compounding than by saving. This is the mathematical moment that makes wealth accumulation self-sustaining rather than entirely contribution dependent. The person who has crossed this threshold, whose investment returns in a given year exceeded their annual contribution, has reached the specific point in the wealth accumulation curve where compound interest has become the dominant force rather than the minor contributor it was in the early years. This is not yet financial independence, but it is the mathematical inflection point toward it. Your net worth has survived a market decline and grown through it. Here's the specific net worth trajectory milestone that confirms the long-term investment strategy is working as intended. Your net worth has experienced a significant market decline. Your investment accounts fell substantially and has subsequently recovered to a new high because the combination of continued contributions during the decline and the market recovery produced a net worth higher than the pre-decline level. This experience, which requires both staying invested through a decline and continuing to contribute during it, is the specific proof of concept for the long-term investment strategy. The abstract principle that staying invested through market volatility produces better long-term outcomes has been personally confirmed through an actual experience with actual money in your actual accounts. The net worth that has been through a market cycle and emerged higher is demonstrably more resilient than the net worth that has only existed during rising markets. The investor who has experienced the cycle knows what their investment psychology is under real conditions rather than hypothetical ones. The net worth itself has been tested and confirmed. The passive income line has appeared on the income statement. Here's the net worth trajectory milestone that is most psychologically significant when it first appears. The investment income, the dividends, the interest, the rental income that is generated by the asset base has grown large enough that it appears as a meaningful line item in the household's income picture. Not meaningful as a replacement for earned income, not yet, but meaningful as a visible, growing, mathematically predictable income stream that is directly connected to the asset base that has been built. The $3,000 per year in dividend and interest income from a $60,000 portfolio is not independence producing, but it is visible, it is real, and it grows with the portfolio, predictably, reliably, without requiring additional work, in a way that makes the trajectory toward genuine passive income coverage of expenses a concrete projection rather than an abstract hope. The specific psychological significance of this milestone, the passive income number, once visible and growing, makes the financial independence target feel achievable in a way that abstract projections don't. You can see the mechanism working. You can calculate how much larger the portfolio needs to be for the passive income to cover your expenses. The goal has moved from theoretical to mathematical, from "I hope this works" to "I can calculate when this works based on current trajectory." The wealth gap has closed more than you realize. Here's the final net worth trajectory sign, the one that is most directly relevant to the video's core premise of getting rich without realizing it, the specific calculation that most people haven't done, which is comparing their current net worth trajectory to the trajectory required to reach their financial independence goal, rather than comparing their current net worth to the final goal. Most people who feel behind in their wealth accumulation are comparing their current balance to their final target. The gap looks enormous because the gap is enormous in absolute terms, but the gap is not the right comparison. The right comparison is between the current trajectory, the rate at which net worth is growing, compounded forward over the remaining years, and the trajectory required to reach the goal by the target date. Many people who feel significantly behind their financial goals are, when the trajectory is calculated, rather than the current balance being compared to the final target, actually on track or close to it, because compound growth front-loads the most dramatic progress in the final third of the accumulation period rather than distributing it evenly. The person with $100,000 invested at 40, targeting $1,500,000 at 65, who is contributing $1,500 per month, is not $1,400,000 behind. They are on a trajectory that produces approximately $1,600,000 at 65 at historical average returns. The gap that looks catastrophic is actually the expected result of compound growth that hasn't yet had the decades to become visible. If you've done this calculation and discovered that your trajectory is better than your current balance implies, that the gap you've been anxious about is partially an artifact of evaluating the compounding process at the midpoint rather than at the end point. That discovery is the most direct confirmation available of the video's core premise. You are getting richer than you realize. The trajectory is the evidence. Chapter 11. The Social Signs. What your relationships are telling you about your financial progress. Here's the chapter that addresses the dimension of wealth-building progress that is least likely to appear on a financial checklist and most likely to be the actual lived experience of someone who is genuinely on the wealth-building path. The social signs, the specific changes in relationships, social dynamics, and interpersonal patterns that accompany genuine financial progress. Changes that are often confusing, occasionally uncomfortable, and consistently under-acknowledged as the meaningful indicators they actually are. Because here's the thing about building wealth in a social environment where most people around you are not. The financial progress eventually becomes visible in the social fabric, in ways that produce specific and identifiable changes in how relationships feel and how social situations land. These changes are signs, not always comfortable ones, but signs. The conversations have changed. Here's the first social sign that is so gradual it's almost imperceptible until it's been happening for long enough to be undeniable. The financial conversations you have, or don't have, with the people in your life have fundamentally changed in character. The financial conversations of financial precarity have a specific texture. They are primarily about problems. The bill that is difficult to cover, the unexpected expense that has disrupted the month, the credit card balance that isn't moving, the paycheck that doesn't quite reach the next one. These conversations are reactive, crisis-oriented, and emotionally heavy. They are about surviving the present rather than building the future. The financial conversations of genuine wealth building have a different texture entirely. They are primarily about decisions, the investment allocation question, the career move being considered, the business opportunity being evaluated, the tax optimization strategy being implemented. These conversations are proactive, future-oriented, and intellectually engaging rather than emotionally heavy. They are about building rather than surviving. If your financial conversations, both the ones you have with others and the ones you have with yourself, have shifted from the survival texture to the building texture, that shift is a sign. It indicates that the underlying financial reality has changed sufficiently that the conversation has changed from managing the present to designing the future. The specific social manifestation of this shift, you find yourself having genuinely interesting financial conversations with people who are similarly oriented. Conversations about investment strategies, business models, career optimization, passive income structures that feel engaging rather than stressful. These conversations may be with a partner, a financially oriented friend, an online community, or a professional network. Their existence in your social life is a sign that your financial orientation has developed to the level where these conversations are natural rather than aspirational. You've attracted the comparison, and it doesn't sting the same way. Here's the social sign that requires the most honest acknowledgement because it involves an experience that most people find uncomfortable to admit. As your financial progress has become visible, you have attracted comparison from people around you, and the comparison has changed in character from the comparison you previously experienced. The comparison that precedes financial progress is the comparison you make about others, the observation that people around you are ahead of where you are, the uncomfortable awareness of the gap between your financial position and the positions of people you perceive as peers. This comparison is emotionally costly because it activates the inadequacy response that social comparison reliably produces. The comparison that accompanies financial progress is the comparison others make about you. The awareness, sometimes explicit and sometimes implicit, that your financial choices and financial trajectory have diverged from the group norm in ways that are becoming visible. This comparison may manifest as comments about your frugality, your investment activity, your career choices, your spending decisions, or simply the visible evidence that your financial situation is improving in ways that others aren't. Here's the sign within the sign. This comparison, which would previously have produced the social discomfort of being seen as different, has stopped stinging in the same way, not because you've indifferent to other people's opinions. That indifference is neither achievable nor desirable, but because the reference point that comparison activates has shifted. You are no longer primarily measuring your financial position against your peer group's current consumption. You are measuring it against your own financial independence target, and the peer group's comparison, while noticed, is simply less relevant to the metric that matters to you. The diminished sting of social comparison is a specific psychological sign of the wealth-building identity shift described earlier in this video. The shift from income optimization to wealth optimization that changes what success looks like, and therefore changes what other people's opinions about your choices produce emotionally. Some friendships have quietly shifted. Here's the social sign that is most uncomfortable to name and most important to acknowledge. Some friendships have naturally, gradually, without drama or deliberate decision, shifted in intensity as your financial orientation has diverged from the financial orientation of the people in those friendships. This is not about becoming elitist, abandoning old friends, or developing the contempt for the financially less sophisticated that the cynical version of the success narrative sometimes produces. It is a much simpler and much more human dynamic. People who share values, priorities, and orientations naturally spend more time together, and people whose values, priorities, and orientations have diverged naturally spend less time together without anyone making a specific decision to withdraw. The friend whose primary social activities are centered on consumption, the expensive dinners, the bar tabs, the shopping trips, the vacations funded by debt, is not a bad person, but their social rhythm and the social rhythm of someone who is actively building wealth are difficult to maintain at high intensity simultaneously because the activities don't overlap and the conversations don't naturally align. The sign is not that these friendships have ended, it is that their intensity has modulated naturally, and that the space created by the natural modulation has been filled by relationships with people whose financial orientation more closely resembles yours. The financially oriented colleague, the entrepreneur you met through a business community, the investor you found in an online forum, the friend of a friend who is on a similar financial trajectory. These relationships have grown as the others have modulated, not through any dramatic social restructuring, but through the natural gravitational pull of shared orientation. If your social circle has gradually shifted to include more people who talk about building things, businesses, investments, skills, financial positions, and fewer people who talk primarily about spending things, that shift is a sign of the financial identity development that wealth accumulation produces and requires. You've become the person. Someone asks, here's the social sign that is simultaneously the most gratifying and the most responsibility-inducing. Someone in your life has started asking you for financial guidance. Not a financial professional asking in a professional capacity. A person in your life, a friend, a family member, a younger colleague, who has observed your financial orientation and your financial trajectory and has decided that you might know something worth knowing. The specific experience this describes, the friend who asks how you choose your investments, the family member who asks how you think about saving, the colleague who asks how you approach paying off debt, the younger person who asks how you think about building toward financial independence. These questions, when they arrive, are a form of social recognition that your financial knowledge and your financial behavior have become visible enough to serve as a reference point for someone else's financial thinking. This sign matters not because being asked for guidance is an achievement in itself, but because of what the asking reflects. The behavior that prompted the question has been visible long enough and consistent enough that it has registered as meaningful to an observer. The financial behaviors that produce wealth accumulation are, in the early years, invisible. They happen in account transfers and investment allocations that no one sees. As the behaviors accumulate into visible outcomes and visible financial orientation, they become noticeable in the social fabric. The questions that arrive are evidence that the accumulation has crossed the visibility threshold. The responsibility that comes with being asked is genuine. The guidance should be honest about what you know and what you don't, careful about the limits of your expertise, and calibrated to the specific situation of the person asking rather than to what worked for you specifically. But the asking itself is a sign worth recognizing. Chapter 12. The final sign, the one that ties everything together. Here's the final chapter, and it addresses the single sign that is both the most important and the most likely to be missed precisely because it is so fundamental that it operates below the level of conscious observation. The sign that is present in every chapter of this video, but that deserves direct acknowledgement rather than being absorbed implicitly from the sum of everything that came before. You are asking the right questions, not the questions that indicate financial anxiety. Do I have enough? Why am I behind? What am I doing wrong? These are the questions of someone measuring the gap rather than building the bridge, not the questions that indicate financial confusion. Where does my money go? What should I be doing? Why does this feel so hard? These are the questions of someone who hasn't yet built the foundation that the earlier chapters of this video describe. The right questions are different. They are the questions of someone who has done enough building to know what they're building, who understands the mechanics well enough to ask about optimization rather than fundamentals, and who has enough momentum to be genuinely engaged with the trajectory rather than anxiously monitoring whether the trajectory exists. What the right questions sound like. Here's what the right financial questions actually sound like. The specific questions that indicate genuine wealth-building engagement, rather than financial anxiety or financial confusion. Am I optimally allocated given my current timeline and risk tolerance? This is not the question of someone wondering whether to invest. It is the question of someone who is invested and is thinking about whether the investment structure is as efficient as it could be. The question presupposes the foundation, the investment account, the contribution habit, the long-term orientation, and asks about the optimization of what has already been built. What is the tax-optimal way to structure this decision? This is not the question of someone avoiding tax obligations. It is the question of someone who has enough assets and income that the tax structure of financial decisions produces meaningfully different after-tax outcomes, and who has developed enough financial knowledge to recognize that the structure matters and to ask about it specifically. How do I accelerate the timeline without taking on disproportionate risk? This is the question of someone who has a specific financial independence target, a current trajectory toward it, and the desire to reach it sooner, who is engaged with the trajectory rather than wondering whether one exists. The question presupposes the trajectory and asks about its optimization. It is the question of someone who is on the path and asking how to move faster on it. What am I missing? This is the question that appears most consistently in the financial conversations of people who are genuinely building wealth. The honest, intellectually humble acknowledgement that the picture they have of their own financial situation is probably incomplete in specific ways that would be worth identifying. It is the question that good financial advisors love to hear because it indicates a client who is genuinely engaged and genuinely open to the guidance that fills the gaps. The meta sign, watching your own progress. Here's the specific behavior that the right questions indicate, and that is itself the most fundamental sign of genuine wealth-building engagement. You are watching your own financial progress with genuine, sustained, intellectually engaged interest, rather than with the mixture of anxiety and avoidance that characterizes the financial relationship of someone who hasn't yet built the momentum this video describes. The anxiety avoidance pattern, the combination of financial worry and deliberate avoidance of the specific information that would convert the worry into actionable knowledge, is the dominant financial psychological pattern for a large portion of the population. People know they should be doing more. The knowing is uncomfortable. The discomfort produces avoidance of the financial details that would make the knowing specific. The avoidance maintains the comfortable vagueness that prevents the discomfort of specific inadequacy. The engaged interest pattern, the genuine curiosity about the financial trajectory, the regular review of the net worth progress, the interest in optimizing what has been built, the reading and learning that develops the knowledge base, is the pattern that this entire video has been describing. It is not the pattern of someone who has everything figured out. It is the pattern of someone who has built enough of a foundation that engaging with it is interesting rather than threatening. The foundation makes engagement feel like building rather than like confrontation with inadequacy. which makes engagement self-sustaining rather than something that requires willpower to maintain. If you are watching your own financial progress with genuine interest, if you look forward to the monthly net worth update, if you find investment optimization genuinely interesting rather than intimidating, if you read financial content because it's engaging rather than because guilt requires it, that orientation is the meta sign. It is the psychological evidence that the wealth-building identity has been genuinely internalized rather than performed. The compound sign. When signs reinforce each other. Here's the final observation about the signs this video has described, and it is the observation that transforms the list from a collection of independent indicators into a unified picture of a specific financial developmental stage. The signs don't accumulate independently, they compound. Each sign reinforces the others. The changed relationship with money makes the automation easier to maintain. The automation reinforces the financial knowledge development. The financial knowledge enables the right conversations. The right conversations develop the network. The network provides the information and encouragement that sustains the motivation. The sustained motivation produces the behavioral consistency. The behavioral consistency accumulates into the net worth trajectory. The net worth trajectory confirms the identity shift, and the identity shift makes every other sign more durable. This compounding is why the person who has several of these signs is genuinely on a different financial trajectory than the person who has none of them. Not because any individual sign is transformative in isolation, but because the signs are mutually reinforcing in a way that makes the aggregate more powerful than the sum of the parts. The person who has changed their relationship with money, automated their financial basics, had the important conversations, quieted their spending, developed operational financial knowledge, diversified their income sources, shifted their relationship with time, survived a financial setback, built consistent behavioral habits, established a positive net worth trajectory, noticed the social signs, and is asking the right questions. This person is not at the beginning of the wealth-building journey. They are in the middle of it, solidly, meaningfully, further along than the gap still remaining would suggest. The permission to acknowledge progress. Here's what this final chapter is ultimately giving. Permission. Permission to acknowledge the progress that financial culture, in with its relentless focus on the gap, the goal, the inadequacy of the current position relative to the ideal, rarely grants. Financial culture is structurally oriented toward motivation through inadequacy. The message that you haven't done enough, saved enough, invested enough, sacrificed enough, that the goal is far away and the current position is inadequate, and the only appropriate response is more urgency and more effort. This orientation is useful as a driver of financial behavior. It is harmful as a description of financial reality because it makes the progress that is actually occurring invisible behind the gap that remains. The signs in this video are the antidote to that invisibility. They are the specific, honest, evidence-based indicators that progress is occurring, that the behaviors are working, the psychology is developing, the trajectory is moving, and the compound growth is accumulating toward the threshold where it will become impossible to miss. You don't need to be done to acknowledge progress. You don't need to have reached the destination to recognize that you are genuinely on the path. You don't need to wait until the account balance reaches the final target to appreciate the psychological development, the behavioral consistency, the financial knowledge, and the trajectory momentum that are the real substance of wealth building. The wealth is being built. The signs say so. You just had to know what to look for. Now you do. Go keep building. And this time, notice that it's working. Chapter 13. The signs in your daily decisions. The micro behaviors that reveal the macro trajectory. Here's the chapter that gets granular, that zooms in from the psychological and social landscape of the previous chapters to the specific, small, daily decisions that most people would dismiss as too mundane to be meaningful indicators of anything. The decision at the grocery store, the response to a sale, the way you think about a restaurant meal, the conversation with yourself about whether to buy something. These micro behaviors are not random. They are the behavioral expression of the financial psychology that has developed over the months and years of deliberate wealth-building work. And they reveal the macro trajectory more honestly than most people realize. Because here's the truth about financial behavior. The large, dramatic financial decisions, the investment account opened, the salary negotiated, the business launched, are important but infrequent. The small, daily, seemingly trivial financial decisions happen hundreds of times per week and collectively determine as much of the financial outcome as the big decisions do. The person whose micro-financial behavior is consistently aligned with wealth building is making hundreds of small, correct decisions per week that compound into significant financial outcomes over time, even if no single decision is remarkable enough to notice. The pause has become automatic. Here's the first micro-behavioral sign. You have developed an automatic pause between the impulse to purchase and the act of purchasing, a brief, involuntary moment of evaluation that didn't exist before and that now operates without requiring conscious effort. The pause is not a lengthy deliberation. It is not an anxious calculation of whether you can afford something. It is a brief, almost subliminal check. Does this align with what I actually value? Is this on my list, or is this a response to a stimulus? Would I still want this tomorrow, or is this a present moment reaction? That takes perhaps 2 to 5 seconds and that either proceeds to the purchase or redirects away from it. The specific financial value of this automatic pause is not any individual instance of redirected spending. It is the aggregate statistical effect of having an evaluation step between impulse and action that catches a specific percentage of impulse purchases that would otherwise proceed automatically. If the pause catches 30% of impulse purchases that would otherwise occur, and the average impulse purchase is $40, and the pause operates approximately 5 times per week, the annual financial effect is approximately $3,000 in redirected spending, without the person feeling significantly deprived because the impulses that were caught before the desire had fully formed. The development of the automatic pause is a behavioral sign because it indicates that the wealth-building psychology has been internalized deeply enough to operate without conscious maintenance. The pause is not something you decided to do before each purchase. It emerged as a natural feature of a changed relationship with consumption. Its emergence is evidence that the change is genuine rather than performed. The sale has lost its power. Here's the second micro-behavioral sign, one that will resonate with anyone who has ever bought something they didn't need because it was on sale and experienced the specific cognitive dissonance of spending money to save money. The sale has largely lost its power over your purchasing behavior. The sale, the 40% off, the limited time offer, the clearance pricing, the buy one get one, is one of the most effectively deployed tools in the retail psychology arsenal. It activates a specific cognitive bias, the loss aversion that makes not taking advantage of a discount feel like losing money, even when the discount is on something that wasn't going to be purchased at full price. The result is the purchase of things that weren't needed, justified by the money saved on something that wasn't going to be bought anyway. A transaction that reduces net worth while producing the psychological sensation of financial cleverness. The person who has genuinely internalized the wealth-building psychology has, gradually and without dramatic decision, largely immunized themselves against this mechanism. Not because sales never represent genuine value, sometimes they do, and buying something you were going to buy anyway at a lower price is straightforwardly good financial behavior, but because the automatic evaluation of is this something I was going to buy regardless of the discount has become a natural filter that separates the genuine deal from the manufactured urgency. If you walk past a sale display without the pull you used to feel, if the 50% off sign has become background information rather than a behavioral trigger, that changed response is a micro-behavioral sign that the wealth-building psychology has genuinely displaced the consumption psychology that previously governed these moments. The cost per use calculation has become instinctive. Here's the third micro-behavioral sign. When evaluating a purchase, you instinctively calculate cost per use, the total cost divided by the number of times you'll realistically use the item, rather than evaluating only the sticker price. The cost per use calculation transforms the apparent price of items in ways that reliably improve purchasing decisions. The $200 coat that will be worn 100 times costs $2 per wear. The $50 coat that will be worn 5 times before being replaced costs $10 per wear. The apparently more expensive item is dramatically cheaper in actual use terms. The calculation that reveals this is simple, takes 2 seconds, and most people never make it. The instinctive version of this calculation, where it happens automatically rather than as a deliberate exercise, indicates that the temporal orientation of the wealth-building psychology has been applied to the specific domain of consumer purchases. The person who automatically thinks about how long they'll own something and how often they'll use it is making purchasing decisions that optimize for actual value rather than sticker price, which produces a consumer spending pattern that is both financially more efficient and qualitatively better because it biases toward fewer, better things rather than more, cheaper things. You've stopped caring what your purchases signal. Here's the fourth micro-behavioral sign, and it's the one that is most clearly a social psychology phenomenon masquerading as a financial one. You have largely stopped caring what your purchasing decisions signal to observers and have started evaluating purchases primarily on their direct value to you. The social signaling function of consumption is powerful and largely invisible to the people it governs. The car that signals success, the neighborhood that signals status, the restaurant that signals sophistication, the clothes that signal belonging to a specific social category. These are not frivolous considerations. Social belonging and social status are genuine human needs, and the consumption that serves them has real value. The problem is the degree to which social signaling drives consumption decisions for things that don't actually produce the social outcomes they're intended to produce, or that produce them at a cost that isn't worth the signal. The person who has shifted their primary identity reference from consumption-based status to wealth accumulation-based identity has reduced the power of social signaling as a consumption driver, not eliminated it because social belonging remains genuinely important, but reduced it to the point where the signal cost is evaluated against the direct value of the item rather than automatically accepted as worth whatever it costs. If you've bought the reliable car instead of the impressive one, moved to the neighborhood that fits the budget instead of the one that signals arrival, chosen the restaurant based on the food rather than the reputation, and found that these decisions produce no meaningful social loss because the people whose opinions matter to you respect financial intentionality more than they respect consumption performance, that pattern of decisions is a micro-behavioral sign of the identity shift this video has been describing throughout. The small pleasures have stayed small. Here's the fifth micro-behavioral sign, the one that most clearly contradicts the deprivation narrative that wealth-building content sometimes implies. The small pleasures have stayed small, the good coffee, the quality meal occasionally, the experience that costs a reasonable amount and produces genuine enjoyment. These have not been eliminated from your life. They have been preserved, enjoyed, and appreciated more genuinely precisely because they haven't been crowded out by the larger, less satisfying consumption that lifestyle inflation produces. This is the sign of the intentional spending orientation that is not about deprivation, but about choosing what genuinely matters. The person who eliminated the spending that didn't produce genuine value and kept the spending that did has a higher quality of life per dollar spent than the person who spends more but less intentionally, and has significantly more financial momentum as a result. The small pleasures that have stayed small are a sign because they indicate that the wealth-building orientation hasn't produced the joyless austerity that critics of financial discipline sometimes describe. The life being built is a full life, just a full life that has been curated rather than accumulated, chosen rather than defaulted into. Chapter 14. The moment you actually realize it. What happens when the signs become undeniable? Here's the final full chapter before the conclusion, the one that describes what happens when the signs described throughout this video accumulate to the point where the progress is no longer something you have to look for, but something that is simply, unmistakably present in the financial reality you're living. The moment you actually realize you're getting richer is not always a dramatic event. It is often a quiet, slightly disorienting experience, a specific moment where the financial reality you're living no longer matches the financial self-image you've been carrying, and the self-image has to update to match the reality. The recalibration moment. Here's what the recalibration moment looks and feels like. The specific experience of realizing that your financial position has progressed further than your self-concept has registered. It might be a conversation where someone asks about your financial situation and you start to give the answer you've been giving for years. The slightly apologetic, slightly uncertain description of someone who is working on it, who is trying to do the right things, who is behind where they want to be. And then you stop. mid-sentence because the answer no longer fits the reality. The reality is better than the answer. The automatic self-description is out of date. It might be an unexpected expense, the car repair, the appliance replacement, the medical bill that arrives and is dealt with from savings without stress, without calculation about what bill to delay, without the specific anxiety that unexpected expenses used to produce. The expense happened. The emergency fund handled it. Life continued without financial disruption. And in the absence of the crisis that used to accompany these events, something registers. This is different from how it used to be. It might be a moment of financial calculation, the quarterly net worth update, the annual review of investment returns, where the numbers are larger than the mental model expected, where the compound growth that was happening silently in the background has accumulated to a figure that the savings contribution mental model would not have predicted, where the investment returns in a single year exceeded the annual contributions, and the implication of that relationship clicked. Whatever form it takes, the recalibration moment has a specific emotional texture. It is not triumphant. It is not the feeling of having won. It is quieter than that. A modest, slightly surprised recognition that the trajectory has been working, that the behaviors have been accumulating, that the compound growth has been compounding, and that the financial position that results is meaningfully different from the position that existed some years ago. The new normal that replaced the old struggle. Here's what the recalibration moment reveals about the progress that preceded it. The financial behaviors that used to require effort and vigilance have become normal. They are no longer disciplines maintained against resistance. They are simply how things work. The automatic investment contribution that used to feel like a sacrifice every month has become background infrastructure whose absence would feel strange. The spending discipline that used to require conscious effort at every decision point has become a default orientation that doesn't require maintenance. The financial knowledge that used to feel like a foreign language has become the natural vocabulary of a financial self-concept that has genuinely internalized the wealth-building orientation. The new normal is the most significant sign of all, because it indicates that the wealth-building behaviors have been sustained long enough to become identity rather than effort. The person who saves because they're disciplined will eventually exhaust the discipline. The person who saves because saving is what they do has no discipline to exhaust. The transition from the former to the latter is what the new normal represents, and recognizing that the transition has occurred is the specific recalibration this chapter is about. The gratitude that isn't complacency. Here's the psychological experience that the recalibration moment ideally produces, and the specific balance it requires to be genuinely healthy rather than either falsely humble or dangerously complacent. A genuine gratitude for the progress made that doesn't become complacency about the progress still to be made. The gratitude is warranted. The behaviors that produced the progress were sustained through difficulty, through the middle. Years when progress was invisible, through the setbacks that had to be absorbed and recovered from, through the social friction of financial choices that diverged from the group norm. The person who maintained the behaviors through all of that has earned the quiet satisfaction of the recalibration moment. The complacency risk is real. The recalibration that produces satisfaction with current progress can, if not balanced by continued forward orientation, become the psychological endpoint of the wealth-building journey before the journey is complete. The emergency fund that is full can become the reason the investment account isn't growing. The satisfactory current income can become the reason the side income development was abandoned. The comfortable current financial position can become the reason the financial independence target drifts back toward abstract aspiration rather than concrete near-term goal. The balance, gratitude for progress made, continued engagement with, progress still required, is the specific psychological orientation that the recalibration moment should produce, not the anxious inadequacy that financial content usually provokes, not the satisfied complacency that comfortable progress can produce, the engaged, grateful, forward-oriented recognition that the journey is real, the progress is real, and the destination is closer than it was, and that the behaviors that produce the progress are worth maintaining until the journey is complete. The compounding that finally becomes visible. Here's the specific financial experience that often accompanies the recalibration moment and that provides the most concrete, numbers-based confirmation that the wealth-building process has reached a meaningful stage. The compound growth that was invisible for years has become visible. The investment portfolio that was growing primarily through contributions for the first several years has reached the size where the annual return, the 7%, or 8% or 9% generated by the existing asset base, is larger than the annual contribution. The account that used to grow primarily because money was added to it now grows primarily because the existing money is generating more money. This mathematical threshold, the point where the portfolio's growth is self-sustaining rather than contribution-dependent, is the specific moment where the wealth-building process visibly shifts into a different gear. The emotional experience of this threshold is different from what most people expect. It is not fireworks and celebration. It is more like the specific, quiet satisfaction of watching a mechanism work. The recognition that the process that was abstract for years has become concrete, that the promise of compound interest has been personally confirmed, that the patience of the early and middle years has produced the specific outcome that the patience was premised on. This moment, whenever it arrives, at whatever portfolio size, it becomes visible for your specific contribution rate, is the financial equivalent of the recalibration moment. It is the numbers confirming what the signs have been indicating throughout this video. The wealth is being built. The process is working. The trajectory is real. What you do with the realization. Here's the final practical question that the realization raises. The question that this chapter and this video ultimately exist to help you answer. Now that you've recognized the signs and acknowledged the progress, what do you do with the recognition? The answer is simpler than it might seem, and it has two parts that operate simultaneously. The first part, keep doing what you've been doing. The behaviors that produce the progress are the behaviors that will complete the journey. The automation that's running, the investment contributions that are flowing, the financial knowledge that's developing, the income diversification that's building, the conversations that have been had, the spending that has been quieted, all of it continues. Not because finishing requires extraordinary new actions, but because the extraordinary thing that finishing requires is the ordinary continuation of what has already been built. The second part, raise the ambition in proportion to the progress. The financial target that was set when the journey was beginning may have been conservative, relative to what is now achievable given the trajectory that has been established. The financial independence timeline that felt aspirational when the journey started may be closer than the original projection suggested. The income target that seemed ambitious may now be the logical next step rather than a stretch goal. The progress already made is the evidence base for raising the ambition, not recklessly, not by abandoning the discipline that produced the progress, but by updating the target in proportion to the demonstrated capability. The combination of continued execution and raised ambition is the specific response to the realization that produces the best outcomes, because it preserves the momentum that produced the progress while directing that momentum toward a destination that is worthy of the journey that reached this point. You are getting richer than you realized. The signs have been there throughout. The progress has been accumulating in the background of a financial life that may have felt like it was falling short of where it should be. The recalibration that this video has been building toward, the specific recognition that the trajectory is real, the progress is meaningful, and the destination is achievable, is not a consolation prize for not having arrived yet. It is the honest, evidence-based assessment of a financial journey that is genuinely underway, of a wealth-building process that is genuinely working, of a person who started something difficult, maintained it through the years when it didn't feel like enough, and has reached the point where the compound growth is becoming visible and the signs are becoming undeniable. That person is you. The wealth you've been building without fully realizing it is real. Now go build the rest of it, with the full knowledge of what you're doing and the full recognition of how far you've already come. Conclusion. Let's bring it all together. You came to this video, or at least you came to the title, because some part of you suspected that maybe, despite the anxiety and the gap and the feeling that financial progress is slower than it should be, something was actually going right, that the behaviors you've been building, the habits you've been maintaining, the financial decisions you've been making might be adding up to something more significant than they feel from the inside. That suspicion was correct. Here's what this video has established across 10 chapters and dozens of specific signs. Your relationship with money has changed, from anxiety-driven scarcity to growth-oriented building. Your financial basics are automated and running reliably in the background. You have had the conversations, the partner conversation, the negotiation conversation, the advisor conversation, the difficult family conversation that most people avoid indefinitely. Your spending has gotten quieter and more intentional as your relationship with consumption has matured. Your financial knowledge has crossed from theoretical to operational. You know what you own, why you own it, and how the tax structure works. Your income has more than one source, even if the second source currently feels small. Your relationship with time has shifted in the specific direction that financial progress produces. You have survived a significant financial setback and your trajectory has recovered. Your daily behaviors, reading the fine print, maintaining estate documents, auditing subscriptions, evaluating financial implications before committing, reflect the financial thoroughness that wealth accumulation requires. And your net worth trajectory, when calculated honestly, is moving in the right direction at a rate that compound interest will eventually make undeniable. Here's the honest synthesis of what all these signs collectively mean. You are earlier in the wealth-building process than the final destination requires, and you are further along than the anxiety of the gap would have you believe. Both things are true simultaneously, and the tension between them, the discomfort of not being done and the reality of having genuinely begun, is the specific psychological experience of the wealth-building middle. The middle is uncomfortable. It is supposed to be uncomfortable. The compound interest hasn't had enough time to produce the visible acceleration that the later stages generate. The financial independence goal still feels more like a mathematical projection than a near-term reality. The gap between where you are and where you're going is still large enough to produce genuine impatience, but the signs are real, the progress is real, the trajectory is real, and the specific combination of psychological change, behavioral consistency, financial knowledge, income diversification, and net worth momentum that this video has described is not the starting point of the wealth-building journey. It is the middle of it, which means the destination is ahead rather than hypothetical. Here's the final thing to take from this video. And it's the thing that the signs were always building toward, the recognition that progress doesn't always feel like progress, especially in the middle. The compound interest that will eventually make the financial independence trajectory obvious is invisible in the early and middle years, not because it isn't working, but because the numbers haven't yet reached the scale where its acceleration is visible. The behavioral habits that will determine the financial outcome over decades feel like ordinary daily decisions rather than significant wealth-building actions, because they are ordinary, and their significance is in the consistency rather than any individual instance. The people who build genuine, meaningful wealth are almost universally people who maintain the behaviors during the years when the behaviors felt routine, who stayed invested when staying invested felt like nothing was happening, who kept contributing when the contributions felt small relative to the goal, who maintained the financial disciplines when maintaining them felt like arbitrary constraint rather than meaningful progress. The signs in this video are the evidence that you are those people, that the behaviors are present, the psychology is developing, and the trajectory is moving in the right direction at a rate that compound interest will eventually make impossible to ignore. Keep going. Not because the end is near, because it may not be, but because the signs say you've already started. Which is the hardest part? Which is the part most people never do? You're doing it. You just hadn't noticed yet. Now you have.